Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So if you look down below, you can see that the bottom of that yellow zone is 103. So I have to get below the top of the yellow zone to break even. I got to get anywhere in the yellow zone, my profit will be increasing, and once I hit the bottom of that yellow zone, I'll have hit max profit, and anything below that is max profit, all the way down to wherever it might go. Max loss, well, max loss is going to be the debit that I paid. I only paid $1.75 on this one, so that means my max loss overall on this trade is a lot lower than it is on the previous trade, and that's because it's the same width of a spread, 3 points, but the maximum gain is a lot higher. So in this case, I've got at risk only a little bit more than the potential that I could make. But again, you can see that if my break even to max profit zone on the orange trade is in the orange bar, but my break even to max profit zone on this trade is in the yellow bar, you can see that this requires the value of this currency pair to be significantly lower in order for it to be both profitable and to hit my max profit level. So same idea, same type of spread. You simply adjust your strike prices based on your level of bearishness. All right, let's do another example. Here's another type of bearish spread that's done using using call spreads. It's a bearish credit call spread. So in this example, I've chosen the Mexican peso because I thought it was a good illustration to use here. You'll notice that the generic profit and loss chart towards the bottom of this slide looks exactly like, or pretty much like, the generic debit put spread that I just showed you. And that's because, yeah, they're almost the same. They're both bearish strategies that have a defined max gain and a defined max loss. And oftentimes I get the question of, well, which do you prefer? Do you prefer debit put spreads or credit call spreads if you're bearish? Well, the answer is it depends. What I typically do when I'm bearish and I want to put on a spread is I take a look at both of them. Every now and then you'll find that if you calculate the max gains and max losses or net cost or whatever, that one might end up being a nickel or a dime cheaper than the other. I'll typically do whichever one has the better price. Sometimes they're exactly the same, but every now and then you'll get a nickel or a dime better price on one. That's the one I would recommend you do. All things being equal, I tend to prefer credit spreads because I like to get paid up front rather than waiting and getting paid at expiration. But occasionally I can get one done for a little bit better price, then I'll always do that. So here an example. I'm going to do two more examples again where these are both bearish trades. They're both credit call spreads, and I simply adjust my level of bearishness by using different strikes. In the first example, I'm going to buy the 126 calls and sell the 123s. That's a 5-point spread. In the second example, I'm going to buy the 128s and sell the 125s. That's also a 3-point spread, but the difference is the amount of the cost. Now, different than debit spreads, credit spreads have a completely different objective. When you do a debit spread, as I've mentioned, your goal is to have both options expire in the money. That's where you make the maximum profit. When you do a credit spread, it's exactly the opposite. Since I get paid up front on day one, my goal is to keep as much of that money that I got on day one at the end. And the way I get to do that is if both options expire completely worthless, then nobody takes any money from me, nothing gets assigned, nothing gets taken away, nothing at all happens. It all just disappears, and I get to keep that money I got up front. All right, let's take a look at these examples like before, only using the chart of the actual underlying index. So let's look at the yellow example first. So here I'm doing what I call an at-the-money credit call spread. And when I say at-the-money on a spread, I'm typically talking about one leg being in the money, one leg being out of the money. You can see that the price of the underlying index is 124.60. So I'm buying the 126, which is, it's a call spread. It's a call, so that means that one's out of the money. And I'm selling the 123 calls, which are actually in the money. So the current price falls right between the two. I would call that an at-the-money spread. This is a moderately bearish spread. Now you can see that the 126 calls are only $1.80. I get to sell the 123s for $3.07, so I bring in a net credit of $1.26. The way you calculate the break-even on a credit call spread is a little bit different. In this case, you take the value, the strike price of the main position, and again, the main position is always the more expensive of the two legs. That's the one that drives your sentiment. The more expensive leg is the 123 calls. I'm short calls. If you understand single leg option strategies, you know that short calls is a bearish strategy. So I take the strike price of the main position, which is 123. I add the amount of the credit that I got, which is $1.26, and I end up with a 124.26 as my break-even price. Well, you can see by looking down at the chart that the current price at the time I took this snapshot was 124.60. But in order to break even on this trade, and remember I'm bearish, this index has to drop to at least 124.26, which happens to be the top edge of that yellow zone that I've drawn in on the chart below. That's where I've got to get to. Now that's a little bit of a tall order, and the reason I say that is because, again, I've got almost 6 months worth of chart viewed here, and this index has never been to 124.26 before. In fact, where it's at right now is about the lowest point it's been on this entire 6-month chart. Now that doesn't mean it won't get there. It's just that you got to break out to new lows that you haven't seen in a long time in order for this to happen. Now, I would suspect that if I looked at this chart on this thing right now, that may well have happened, but back then I didn't necessarily know that. And you can see when this was done, it was back in actually that was January, so I did this several months ago. Now where's my max gain? My max gain, remember, happens when both options expire worthless and I get to keep all the money I brought in on day one. Well, that's $1.26, so my max gain is the credit I received, or $1.26. That occurs when both options expire worthless. Call options expire worthless if the underlying is below the strike prices. So, in other words, this index has to drop below 123 for both options to expire worthless, and I get to keep the entire $1.26, and I hit my maximum gain. Well, 123 happens to be the very bottom edge of that yellow zone that I've drawn in below. Now, anything below that, of course, is the max gain, and you can't see it on the chart, but 123 is the top of the max gain. Anything below that is max gain all the way on down to however low it can go. So not only do I need downside movement to break even, I need quite a bit of downside movement in order to hit my max gain on this. What about my max loss? Well, if my goal is to have both options expire worthless, that means my max loss occurs when both options expire in the money. Where would that occur? Well, of course, that would occur when the index is just above the highest strike, so at 126 or above. Now, I didn't draw 126 in down on the chart, but you can see that that's actually at a point that isn't a whole lot higher than where it's at right now. And in fact, I would say, based on this chart, assuming I did that today, yesterday, this thing was in the max loss zone, if today was the day I did this chart. So you've got to get downside movement on this one in order for it to be profitable. This is not a neutral trade. This is a bearish trade, and it has to be bearish. Now, that might be a little bit too aggressive for you. You might say, hey, you know, breaking out the new 5-6 month lows is pretty hard, tall order. How can I capitalize on this thing without being quite so aggressive? Well, the next example is a good one. Instead of buying 126s and selling 123s, why don't I buy 128s and sell the 125s? This trade gets done for a net credit of only 78. That, of course, means that your maximum profit goes down from $1.26 or $1,260 to only $780. But the benefit is, looking again at the most expensive leg, it's a strike of 125. Add the amount of the credit, I got a break-even price of 125.78. Well, look where the index is now, 124.60. That means I'm already below my break-even price. And even better, where's my max gain price? Well, my max gain occurs when both options expire worthless. That means it has to be below 125. Where's it at now? 124.60. Not only am I below my break-even price, I'm below my max gain price already. So this strategy, although you have a bearish bias, can actually be profitable in a completely neutral environment. Even if this stock or if this underlying index goes nowhere, this thing is already 40 cents below the maximum profit zone. So that's why I call this slightly bearish to neutral.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.